Welcome back to another episode of Talking Stocks. Joe and Todd here with our weekly roundup of all that's going on in the investing world. Todd, we're going to start out with you this week because you have a chart that you posted on Twitter earlier this week about the S&P moving averages. So why don't you get us going?
Yeah, I thought this was really interesting to go back and take a look and say, okay, I know the market's made a big move since the March low, that's March of 2020. And many people are arguing, oh, we're so extended, we've had such this big run. So I thought it might be useful to go back and take a look at what the market did after the 2009 low and kind of get a feel for, well, maybe we do normally run pretty extended to the 200-day moving average following a bear market low. And sure enough, that's what I discovered. So I want to share my screen. So if you're on YouTube, you'll be able to see it. If you're on Twitter, I'll do my best to walk you through it. But I want to share my screen and show this chart that I put together. And Joe, what we're looking at here is the S&P 500 on an adjusted closing basis from the 2009 low in March, right on through where we were at the beginning of this week. Okay, so on the far left-hand side, Joe, you'll see that at the worst, oh boy, this was such a tough time to be investing. At the worst, we were more than 30% below the 200-day moving average on the S&P 500. The SPY is the exchange traded fund symbol. And then we had that big rally beginning in March 2009, and we saw this huge move from March all the way up through the end of 2010, and obviously the launch pad for the huge stock market returns that we've seen over the last decade. One of the things that I found really fascinating here, Joe, is if you look at this period, which really was right around June of 2009, so about 3 months into the low from March 2009, we eclipsed the double digit extended above the 200-day moving average. And we remained there, Joe, all the way through the remainder of 2009. I think the average was 13 or 14% above the 200-day moving average. So if you look at where we are today, again, we're at the double digits. We're into the double digits now off that big low that we had in the springtime. But as you can see from looking at the way the market acted after that 2009 low, you got many, many months where you were trading very far above the 200-day moving average. And we're really, comparatively, haven't really done that. So I guess what I would say is a big takeaway from this, Joe, to just remind everybody, don't get too caught up on where the S&P is right now relative to its 200-day moving average. Just basically recognize that when you have a period where you're so massively oversold, there's so much energy, so many people who still want to get into the market, who maybe didn't get in say March, but thought, hey, maybe I'll get it on when it falls again. I'll buy it in April. Nope, couldn't buy it in April, couldn't buy it in May, couldn't buy it in June. And each month that goes by, more of them are finally saying, yeah, I really have to get back into that market. And as a result, the market tends to run a little hot. And it takes a while for a 200-day moving average to catch up. So, we'll see this normalize over time, like we did, 2011 through 2018. We'll see that normalize over time. But I just wanted to drive that point home for people and show that it's really not that bizarre behavior right now, as far as trying to figure out, well, is the market too hot or overextended?
Yeah, you can definitely see some patterns there, like post-recession and also just the market corrections, like the late 2018 market correction, for sure. So we'll get into, later in the episode, we'll get into some specific stock picks for the gurus out there who are listening. But in the meantime, we wanted to focus this week on kind of the young, more inexperienced investors who are just starting out. And, these are either college students or they're just out of college and they just started a new job and they've got some spending money or some money saved that they don't really know what to do with. And I know Todd gets this question a lot from his students, and I've even gotten this question before from some friends. Where do I start? And, is it okay? I have, $25 extra every month. Is that enough to start with? And I think the short answer is yes, but go ahead and give us the long answer.
Yeah, it's absolutely yes. I think that you run the risk of analysis paralysis if you think about it too much. I mean, there's a lot of platforms you can open your account on: E-Trade, Schwab, Vanguard. Most of them are pretty equivalent in what they'll do now and give you. So I mean, just pick one, pick one, just do it, and just steal from Nike, just do it. Get started. I mean, Joe, one of the biggest, most important decisions I made as a young man was to take just a little extra money that I was getting every month from working while I was in college and putting that into an aggressive growth fund. This was back in the early 1990s. And it was a really small amount. It was like $50 a month. I had extra just from working my part-time job while I was also taking my classes. And I put it into this aggressive growth fund. And I just did it consistently. Every month I contributed that $50. And then when I graduated from college, I got my first real job. I increased it a little bit. And then when I got a raise the next year, I increased it a little bit. So again, consistently allowing that money to build up in this aggressive growth fund. And then fast forward into my late 20s, Joe, that became my down payment on my house. So these little amounts, they seem like, it's $25, that's just beer and pizza money. Well, over time, that can turn into a much, much more significant amount of money. You can buy a lot of beer and pizza thanks to compounding over time.
A lot of fridges to put your beer and pizza in.
That's right. I mean, I always look at, people say, well, what's compound? What's compound interest? Why is that so important? And, it's feeling to earn interest on your interest. So Joe, if you invest $100 and you earn 10%, you now have $110. If you earn 10% on $110, that's an extra $11. You now have $121. If you earn 10% on $121, you get the point. You get the gist. So for me, I think the biggest takeaway for people who are on the side, I don't have a lot of money, just do it. Just do it and be consistent. I'd much rather see someone be consistent and monthly, adding money every month, than say taking a lump sum of $1,000, putting it into Robinhood and making some stupid decisions and then end up wiping out. It consistently into great companies or into a mutual fund, or exchange traded funds are great, something like that.
Yeah. And the other thing that's important is, a lot of these big firms, they might seem intimidating, but to open an account, whether it's a brokerage account or an IRA, it takes minutes. And that's not an exaggeration. Like when I opened my IRA, it took a matter of minutes. It takes a little bit longer than that for it to get approved, but the process takes 10 minutes.
Right. And you brought up a great point too. I mean, I had done back in the 90s, I had just done a regular account, a regular investment account, taxable investment account. But you could do IRAs. If you have a job and you're earning income, you can open an IRA. Now that raises a whole nother question, right, Joe? Traditional versus Roth IRA or whatever.
Absolutely.
What did you choose? Did you choose a traditional or a Roth IRA?
I have a Roth, and I didn't do a ton of research on it when I opened it up. But for me, it just seemed like at the time that tax-wise, I would rather have to pay the tax now rather than pay the tax when I'm 62, 65, 70, whatever.
Right. And that's the difference between the traditional and the Roth IRA, is that with the traditional, you get the tax deduction up front, but you're going to have to pay income taxes on the money when you take it out in retirement. And then the reverse is true with the Roth IRA. You don't get that tax deduction up front, but you do get to withdraw the money, the earnings in retirement, tax-free. And I think one of the things that's important to remember with the Roth is it does give you some flexibility, because since you are contributing with after-tax dollars, you can take your contributions out. You have to meet just some basic guidelines, but you can take your contributions back out.
That's right.
Without having to do that. But
for certain events, if I'm not mistaken, like down payment on a house, and I think like a wedding, and there are a few other circumstances, not that you necessarily want to, but it's just nice to know that if you needed a little bit more for a down payment on a house or something like that, that you could tap into that if you theoretically needed to.
Right. That's one reason that I did that with my son, who's a teenager. He has a part-time job now and he's making a little extra money. I didn't want to fight him with money. So we came up with an idea. Start a Roth IRA. You can contribute a little money to your Roth IRA, pick some stocks and own them in your portfolio. And in the back of my mind, I'm thinking to myself, if he needs to, he can tap this money for his down payment on his first home or whatever, or he can just let it build over time and have other savings. Now, in my personal life, I've always used more of the traditional IRAs because I wanted to have the tax deduction. So each person is going to be a little bit different on for their particular situation. And there are some rules, associated with the IRAs. You can only earn up a certain amount of income every year. Those change every year. Best way to find out and stay on top of it is just to Google IRS IRA contribution limits. And it'll bring you right to the website at the IRS. You'll be able to look at, see all the limits and restrictions. But for most people, especially if you're young and you're just starting out, you're not going to have to worry about those income restrictions. They're really just for people who are now maybe hitting their stride in income. But for younger people just getting started out. The other thing too, Joe, a lot of people don't know this, there is something called a saver's credit. So you could qualify for a saver's credit. So if you fill out your own tax form, you want to be aware of it. The saver's credit can give you up to a 50% tax credit. Now remember, not a tax deduction, which lowers your taxable income, but a tax credit would actually lower the amount of taxes you have to send to the government. So if you have income below their certain limits, you could get the saver's credit as well. So that's an extra added incentive to someone maybe who's young and just starting out to go out and actually, as I said before, just do it. Open the account, put some money aside.
Absolutely. So moving on then, so you've made it to this first stage, you have an account, whatever it is, brokerage account, IRA, you might have $25 in it, you might have $2,500, you might have 25,000. Regardless, what's the approach for somebody in the 18 to 25 age range? It's all about growth, right?
I think so. I mean, you have growth investing and you have value investing, right? And if you look at value investing, you're probably thinking, Warren Buffett, right?
Exactly.
This whole idea of I'm going to buy stocks really, really cheap, and then I'm just going to let them appreciate over time forever. And that can work. It can work. But if you look at the data over time, for most investors, it's been better to focus on growth stocks. And when I say growth stocks, I mean companies that are seeing year-over-year revenue growth of, let's say, 20% or higher, and they're seeing improving in the earnings. They're also, say, 20, 25%. If you're looking at William O'Neill's research, he said that the biggest winners were usually growing at a pace of 25% over time. So I mean, you can either buy the S&P 500, index ETF, which is going to have some value stocks, some growth stocks, whatever. Or if you're picking and focusing on individual stocks, I would focus on growth or aggressive growth since you're so young. You have so much time to make up for any potential hiccups along the way. I would do that instead of value.
Yeah, absolutely. I agree. And when in doubt, if you're overwhelmed by the just massive amount of different stocks out there, or you just simply don't have time to put in your research, there are so many ETFs and mutual funds that are fantastic. If you just, when you're in your brokerage account, if you just search, growth or high growth or long-term growth, you'll find just a laundry list of different potential funds, some of which, you need to do a little bit of background research and just see, how they're rated, where the assets are allocated. But for the most part, those are a safe bet as well.
Yeah, I mean, and the other thing is too, Joe, you can think about it strategically and say, well, I do want to have a little bit, I want to have, say, most of my money, say 80% in an S&P 500 exchange traded fund. Let's just put that 80% in there and let the market do what the market's going to do. And then maybe take the other 20% and be focused on maybe these more aggressive parts of the market or individual stocks that you think offer upside opportunity. What I wouldn't do is I wouldn't just go and run around and chase whatever you happen to see on Robinhood or Fintuit as being hot stock. One of the things in my class that I teach how to talk stocks, we start off very, very top level and say, what are the products you love? What are the businesses that you love? And then come up with, some sort of a thesis for why you think that that's a stock worth owning. So for example, if you love Dunkin' Donuts coffee, you might say to yourself, I love Dunkin' Donuts coffee. Everybody's going to continue to drink coffee. I think this one could be a very good investment. You start there. And then from that, you can start looking at these individual things and say, okay, is this good investment? So what you want to do is you want to say, okay, well, what's the size of the coffee market? And is it growing or is it shrinking? what is Dunkin' Donuts' share of that coffee market? And then you want to say, okay, well, what are some of the risks? Well, they have competition from Starbucks and others that you have to keep in mind. Okay, so you have to keep innovating. Can they navigate those risks? Yeah, I think they can navigate those risks, right? So then you would say to yourself, okay, well, let's look at a couple financial metrics and see whether or not the financial metrics look good. And for me, if I was pushed into a corner and said, you only have a couple seconds to analyze the stock and you only pick 3 financial data points to consider, for me, it'd be year over year growth. It's always the rate of change. So year over year growth in revenue, operating margin, the trend in operating margin, and the year over year growth in earnings. So those would be the 3. And then from that, you should then be able to come to a conclusion of whether or not you want to own the stock. That's a very loose framework, but at least it gives you a starting point to be able to say, okay, if I want to start investing in individual stocks, I don't want to just, click a button because I saw it in Robinhood or somebody was talking about it in the store and I overheard them. That's kind of the thinking that you should approach these stocks with.
Exactly. That might not be like the most thorough research, but at least that way you'll be able to weed out a lot of stocks that you probably don't want to invest in. And again, when in
And
doubt,
the
there's
other
always
thing, Joe,
ETFs.
yeah, and then the other thing, Joe, too, is you have to decide what's right with your sleep at night factor. If you're young and you're single and you don't have any kids, you can probably have all of your money just in stocks, and then maybe some emergency savings to pay, your rent if something happens, rather than say buying something very safe, like or safer, like bonds or having it in a money market account or something like that. Allocation, whether that be in equities or be in bonds, that really doesn't come into play until you're to have a much larger account and you have some responsibilities at home. And usually the rule of thumb on that is simply just say, take 110. So let's assume that the longest that you're going to live is 110, something like that. And then subtract your current age from that. And then that's the amount that you should have invested. So let's say that you think that you're going to live to 100, right? And let's say you're 30 now. Well, have 70% of your money in stock.
Yep. That's an excellent framework as well. So there's another kind of scenario for people who are on the kind of upper end of this 18 to 25 age bracket. So they're out of college, they're employed, and they're employed full time. And because of that, they have 401k plans available to them. So again, this can be somewhat of an overwhelming thing for people who don't have a lot of experience in investing. So especially for people who already have a brokerage account or an IRA of some sort, how do you suggest these kind of recent college grads approach the 401k?
Absolutely get in on that 401k. There might be
Totally.
matching dollars that are associated. I am amazed, Joe. I am absolutely amazed at how high the percentage of it is. Workers that have access to a 401 or a 403b plan that don't take advantage of it. It seems 100% silly to me. Take advantage of it. And, honestly, it may seem tough initially, but try to do 10 to 15% of your money into your 401 or 403b plan. Live a little lean in your early years when you're single, you're just starting out. Live a little bit leaner than you might want to, because again, compounding will pay off for you the more you put in up front when you're young. It's just so important. And I talk to people and they're like, yeah, I have my 401k plan. Well, what do you contribute? Oh, 3%, 5%. Oh, you're not going to generate real wealth at 3 to 5%. All right. Think 10 to 15% if you really want to move the needle when it comes to accumulating a high net worth for retirement. So yes, as soon as you get that job, as soon as you get that form, fill it out. At a very minimum, Joe, go up to the matching number.
Yep.
Whatever they match. If they don't match, whatever, doesn't matter. Still participate in the 401k plan. Still do it. I would also recommend, and Joe, they're doing this a lot more now. They have something called auto escalation features. So what you do is you check mark a box, And every year it will automatically increase how much you contribute to your 401k. You won't even, you set it and forget. And what's great about that is, like, let's say you get a 3% raise every year. You've also set your auto escalator to go up by, say, like 1% a year, right? You won't even notice it. You won't even notice it. And yet, thanks to compounding, another great way to be able to build up a huge account in the end.
That's right. It makes a huge difference in the long run. And one thing that you mentioned in there that's really, really important to point out is matching, because it is literally free money. And if you're, anybody should be taking full advantage of that. If it's, regardless, again, as you said, if it's 1%, 3%, 5%, doesn't matter. If you're not contributing that full percentage, you are leaving money on the table that is available to you at basically no cost.
You just nailed it. Absolutely. I mean, that would be silly. Would you walk away from a $20 bill that was just laying there on the table in front of you? No.
Right. Exactly. Never. Yeah. So you also pointed out living lean, which is a very, very important message for, people who are out in the workforce, and maybe they get a promotion and they're really tempted to go on a big extravagant trip, or, move into a really nice apartment, or go out and buy a brand new BMW. And that stuff's great, but that's not long-term kind of financial responsibility, I suppose. It's great. It's great. It's a great short-term indulgence, but how long are you going to have that new BMW before the maintenance comes back and bites you in the butt?
Right. And then you're just going to lease it, or you're going to turn it over every 3 years, and you're going to be upside down. So you're going to have that payment forever. Right. Does that make sense? No. I mean, we do one of the exercises that we do in the classes. We pull up the compound interest calculator. You can just Google on Google compound interest calculator plus government, and the government has a great compound interest calculator. And when we pull it up and we say, okay, well, what do you think your monthly payment would be? And then we figure out, okay, the average monthly payment is usually about $400 or $500 a month. And then we say, okay, well, if you had taken that $400 or $500 a month, put that instead into the S&P 500, how much would that be worth if it earned 6% on average per year for the next 40 years, or 8%, or 10%? And what you find out is that the opportunity cost of owning that fancy BMW is $1 million. It's $1 million decision.
Yep. Yeah. It's a $1 million mistake leasing or buying a $40,000 car. It's pretty remarkable. The other calculator that I've seen and used before is, if you, again, just Google like Roth IRA calculator or traditional IRA calculator, and there are all these different websites that have these tools. You can put in your current age, the age that you want to retire, and then your annual contribution. So obviously it'll cap you at the limit, which is like 6,000 and something for a Roth. And it'll show you this beautiful graph of, if you just contribute $5,000 a year, that will appreciate to $1 million by the time you're 50. If, with the standard S&P 500 return of, 6 to 10% annually.
Yeah, it's phenomenal. How much, and I think that those calculators and those tools really drive it home. So even if you're a listener, maybe you're already investing, you do your 401k, you're following through on all these things, share it with your kids. Show them at a relatively early age these calculators, and let them play around with it. And I think that maybe that will instill some really good financial discipline within them as well.
Yeah, I think I got my IRA when I was like 19, and I have a buddy whose parents signed him up for one at like 15, and I'm a little bit jealous of him. He's like, I sort of feel like he's 4 years ahead of me.
Right, and he is, with 4 years of compounding, right? So I mean, it does make sense to try and do that, and like I did with my son when he got his first part-time job with that Roth IRA as well. That's
Absolutely.
Something that parents might want to consider doing for the young investors in their life.
Yeah. So just wrapping things up on this segment. So there are a few morals of this story. First moral is just do it, as you said. So easy. Whether you have 25 bucks or you have 2,500 bucks, just start. Put it into an index fund or an ETF and just let it ride. Contribute regularly. When you're out of school, live lean and let it grow because it'll pay off in the end. I think that's pretty much the moral of the story there.
Absolutely.
All right. So with that, you want to move on to our final segment of the day. I think you have some stock picks for our more seasoned investors that might be listening or watching.
All right. So for Limelight Alpha, one of the is an idea generation machine. That's why I always viewed it is to take 1,000, 1,500 stocks, run it through the 7-factor model that we have to try and spit out a more actionable number of names that we can research and see whether or not they're stocks that are worthy of including in portfolios. So every week, what I do is I take a look at the best scoring list that we put out for large cap, mid cap, and small cap. And I go through and I highlight ones that are making the biggest moves. But that list is a great source of new ideas for me. And I'm always finding something new to add to my watch list. I thought it'd be fun to do this on a regular basis. We'll do this every week. We'll go through, I'll pick up a couple of stocks that have caught my eye that I think people might want to consider. So again, I'm going to swap to share my screen. So if you're watching on YouTube, you'll see it. If you're listening on the podcast, I'll do my best to explain what it is I'm looking at. So as I share that, one of the things I just wanted to pull up, okay, so the first stock that I'm going to pull up today that I caught from our large cap report is Equifax. So Equifax, as you know, does the credit monitoring that so if a bank wants to loan you money, they're going to pull your credit report. And you can also, as an individual, go in and keep tabs on your credit score and all that kind of stuff. Well, Equifax is one of the big companies that's involved in that. And you can see that it checks a lot of the boxes that I like to check when it comes to a stock that might be interesting and worth buying. One, I think that, demand for checking people's credit is going to increase given the fact that, we do have some economic concerns going forward. We have some people who have some job losses. We have banks that are more and more selective in who they'll lend money to. So I think that there's a tailwind there for demand for the company's mainline services. You can see that the company is growing year over year revenue by double digits. I'd like to see that. I'd like to see a little bit better earnings growth. You see 7% from 19 to 20 and 4% from 20 to 21 on the forecast. But still, that's pretty good considering we're in COVID times, right? Pandemic, right, Joe? I mean,
Absolutely.
562 to 599 to 621. I mean, that kind of consistency is valuable. And then you can just see that, okay, we've got a stock that if you look at over the course of the last 6 months or so, has been ascending. It's been consolidating in here. We've got some really nice buy volume. And the sell days really haven't been that too scary. So the money flow is solid as well. So that's a stock, Joe, that I think people might want to take a look at. I would also follow that one up with Autodesk. And Autodesk does like CAD software, helps engineering companies, etc., in doing their planning. And one of the things that you'll notice on Autodesk, a high-scoring stock research, is it's got that double-digit revenue growth that we're talking about. Now, it actually is growing earnings or expected to grow earnings at a much more rapid pace. So this would be much more of a growth-oriented stock. So we've got the 36% 2021 EPS forecast and growth, 38% in 2022. So again, I think that if you're looking for a software stock to include in portfolios, you might want to consider Autodesk. I'll also highlight for people a company that, Joe, back in the old times, we used to call it Cool Looking Sofa. Cool Looking Sofa is a semiconductor equipment manufacturer. And I think I've talked in the show about the seasonal, last week's show, we talked about seasonality and how seasonality is pretty strong for semiconductors. The book-to-bill usually runs the hottest or the best from now until the springtime, and stocks tend to perform the best from now until springtime in the semiconductor area. And again, checks marks a lot of boxes for me. You get that nice solid revenue growth, 18% year over year in the most recent quarter, 30% in the quarter prior to that. You've got significant earnings expansion coming off the low here in 2019. So COVID times not making as much as it did in 2018, but expected to double its earnings in 2020 and then grow another 63% in 2021. So if you're looking for some semiconductor exposure and you want a smaller company to consider, I think Silicon Software makes some sense. Market cap is about 1.6 billion. And then I would also say, for those of us who are also looking at seasonality type oriented plays, you might want to take a look at Compass Minerals. Keep an eye on this stock. Symbol there is CMP. They make, salts that are used in de-icing roads, and there's absolutely seasonality as we
That
know
time of
here in
year.
the Northeast to that business. So the stock certainly does perform well, tends to perform well through these winter months. So keep an eye on that if you're looking at kind of a non-tech stock that you wanted to include in your portfolio. And then I would just wrap it up by saying, we're coming up on the holiday season. We've seen some interesting moves in some of these stocks that are retail oriented or tied to holiday sales. You might want to keep an eye on something like Hasbro or even Mattel, symbol there, HAS and MAT. They could benefit obviously from holiday shopping trends, and they score very high in our research. Again, positive money flow, positive expected earnings growth going forward. So those are just a few of the names that I pulled out of this week's fund, Joe, that I thought might be interesting for people to add to their watch list.
Absolutely. That's great. And I think that's a great place to leave it for the week. So do you have any last words for us before we wrap up?
No, just make sure that if you're a newer investor and you're just getting started, don't get overwhelmed. Just do it. Pick a platform, contribute a little extra money to an account every month. It will pay off over time.
All right. Well, we'll leave it there. So thank you all for listening or watching, and we'll see you next week.